good afternoon, everybody, and welcome to the Magellan Global Listed Infrastructure webinar. My name's Alan Evans, and I'm one of the key account managers at Magellan, and I'll be hosting today's webinar. Of course, no presentation would be complete without the very important disclaimer, which will appear on your screen shortly. Please read through the disclaimer. Perfect, you've all had time to read it. I'm going to be joined today by three of our portfolio managers from the infrastructure team: lead portfolio manager and head of investments, Gerald Stack, Ben McVicker, and Offa Carliner. To run through today's agenda, I'll now hand over to Gerald Stack.
Thanks, Al, and thank you for everyone for joining today. We really appreciate everyone participating in the webinar today. Now, today, our agenda is really threefold. We're going to start very briefly revisiting how we think about infrastructure. We're then going to talk a little bit about the fund portfolio and what's happened to the portfolio over the course of the year, and how we've changed the portfolio. We're then going to drill down and focus on the key sectors in the portfolio and talk a little bit about their fundamentals, their investment performance, and the outlook for each of those sectors. I'll talk about utilities. Offa Carliner will talk about airports and rail, and Ben McVicker will talk about toll roads and communications infrastructure. So with that set up, let's talk a little bit about how we think about infrastructure. And most of you who've heard us talk before will have seen this slide. This is the essence of the way that we think about infrastructure, and that is that infrastructure are assets that provide essential services that are essential for the efficient functioning of the community, and that really means that demand is reliable. In addition to that, we require that earnings are not sensitive to competition, commodity price, or sovereign risk. So you end up with very reliable cash flows. So what you should be left with is a group of assets that are highly defensive, inflation-linked, with low correlation to the underlying economy. Essentially very boring, reliable earnings and cash flows. That's the essence of what we want. So if we look over the page, you'll see what that universe actually looks like. There's roughly 130 stocks that sit in our universe, divided into three major buckets. The first bucket is utilities. Utilities account for about 60% of our universe. Transport infrastructure, that is infrastructure assets involved in the transport of people, goods, data, account for nearly 40% of our universe. And social infrastructure, which is quite a big part of the unlisted infrastructure, is a very small part of the listed environment. There's around about 1%, two companies essentially. So really what we're talking about is utilities and transport. Those things below the dotted line, there are things that we don't invest in that many people will call infrastructure but don't meet our criteria. So really, what are we talking about? We're talking about 130 stocks essentially in utilities and transport, market cap of about $1.5 trillion US, so about the size of the Australian Stock Exchange. All right, so with that behind us, let's talk a little bit about what's happened to the portfolio over the course of the year. So back in December, seemingly a lifetime ago, you can see our portfolio was roughly 54% in infrastructure, the blue and the grey segments there. This is on the left-hand side of the slide, and roughly 41% in utilities. So if you think about what our universe looks like, our universe is roughly 60% utilities and 40% infrastructure. You can see we were somewhat diametrically opposed to our universe. When COVID became apparent, when the pandemic became apparent and the quarantining from that became obvious, we moved to, given the levels of risk and uncertainty, we moved to make our defensive our portfolio more defensive. And we particularly sold down airports. We moved to a structure that was essentially at the time 41%, 42% utilities, around about 44, 45% infrastructure, and around about 15% cash. You can see today in September, we've reduced that cash to around about 10%. We've increased our weighting progressively over the course of the year from sort of 41, 42% utilities to 46% utilities, and we've held our infrastructure component at around about 44%. So in essence, what we've done, our tactics over the course of the year have been to look for those things, those assets, those companies that for whom face relatively low levels of uncertainty about their future earnings, but have some degree of upside. In other words, low levels of downside, some degree of upside. And that's meant that we've stayed away from airports, notwithstanding the fact that airports from time to time have certainly looked cheap to us. So we've certainly been more defensive in the way that we've gone about this, and that continues to this day. We're continuing to allocate progressively some of that cash back into the portfolio, and we're looking for those things with low levels of downside, some degree of upside. Now, each of the guys and myself will take you through those major sectors as we move through this, looking at fundamentals, investment performance, and outlook. And let's start with utilities. All right, so utilities. So this slide is seeking to explain how the economic model for regulated utilities. With a standard company, you produce a good or you produce a service, you go out and sell that at the price that you can achieve, you deduct your costs, and what's left over is profit. So profit is the last part of that equation. For a regulated utility, it works the other way. You essentially start with profit and work backwards to work out your price. The regulator allows you to earn a fair cost of capital on your rate base. So if you've got $1 billion rate base, you might be allowed to earn sort of 8.5%, which means that you can earn roughly $85 million. And you know from this outset that your profit after tax should be roughly $85 million. From that, you add back your costs to work out what your total revenue requirement is. You divide that by volume, and the revenue divided by volume is then the price that you'll charge consumers. So as I said, somewhat diametrically opposed to a normal company. And what it does mean is that for a regulated utility, you should have very reliable earnings because that's where you start. So then if we think about what's happened this year, step one is essentially to think about what the pandemic has meant for volumes. And the pandemic has meant a reduction in volumes. Whether you're a water utility or an energy, gas or electricity utility, the fact that people have not been at their place of work, they've been quarantining at home, has meant a reduction in commercial and industrial volumes. That's been offset somewhat with an increase in the volumes of those services in residential homes. But nevertheless, net, there's been a reduction in volumes. A reduction in volumes, given the price has been set, means that at step two, we have a reduction in revenue. So the level of revenue these utilities have earned has gone down. And they've also been faced with some bad debts. There's clearly been some companies who are not going to be able to pay their utility bills. So they've faced this reduction in revenue and bad debts. And for a normal company, given that that revenue is where you start, that would be a bad thing for underlying earnings. At step three, though, you'll see that what's happened here is that the utilities have been able to reduce their costs, or they've been able to work with their regulator to spread the negative impacts of COVID and the pandemic over the medium term. They've been able to push out the impacts of this over the long term. And the net result of that is their profits are largely unaffected. And indeed, if we look at the next slide, what you'll see is that of our sort of essentially our top 10 utility positions, you'll see there on the far right-hand side, they've all got a green tick against them. What that green tick means is that at the start of the year, these companies provided earnings guidance for the full year. And 9 months through the year, they basically all signed off on their earnings guidance at the start of the year. You can see American Water slightly different. But in essence, the bulk of these utilities are very much in line with where they expected to be at the start of the year. And in general, not always, but in general, that earnings guidance at the start of the year was for a 5% earnings growth. So notwithstanding the fact that the pandemic has been a significant issue, they've been able to work with their regulators to make sure that their earnings are unaffected through the course of the year. This is very much to thesis what we would expect from regulated utilities. Now, if we move to the next slide, you'll see we start by saying earnings largely unaffected. And what we're trying to do is say, well, how do we think about the outlook for regulated utilities? So yes, earnings have been unaffected, in addition to which interest rates are lower. If we'd asked us at the start of the year what our base case was for the interest rate outlook, it would have been for lower interest rates for some time to come. As we sit here today, we'd have to say that our base case, not the only case, but certainly our base case is that interest rates will be lower for a lot longer. So you've got earnings unaffected for regulated utilities. You've got interest rates very low. And while interest rates are not the only thing that affect utility valuations, they're certainly supportive. So you've got a very supportive valuation environment along with that largely unaffected earnings. So notwithstanding that, if we look to the next page, you'll see that utilities looking at their investment returns for the period to the end of October are actually down over that period. This is on average. This is an analysis we've done looking at the average performance of regulated utilities over the course of the year. So on average, utility values are down through that course of the period, notwithstanding the fact that their earnings are unaffected and you have this somewhat supportive valuation environment. For us, that means the outlook from here is actually pretty attractive. Regulated utilities for us, in terms of our portfolio, are traditionally a place where we expect to get a fair return, but not certainly not a get-rich-quick type of environment. Now, we're still not saying utilities are get-rich-quick, but if we said our normal expectation is inflation +5, let's call inflation 2 for a total return of 7. In the current environment, given what's gone on over the course of the year, we're probably expecting 8-9%, an additional 1 or 2% per annum over the next sort of 5 years or so. So they're relatively attractive. For us, this is, as I said, an attractive part of our portfolio. We've seen earnings unaffected. We have this supportive interest rate environment. We think there's attractive opportunities here. All right, with that, we're going to move to Offer. Offer's going to take us through airports.
Thanks very much, Gerald. On the slide you can see in front of you now, I'm going to walk you through the economic model about how airports actually make their money. And there's 3 key components here. There's the aeronautical price, so what they charge the airlines to bring passengers to the airport, and it's usually a per passenger charge. There's the retail spend per passenger, how much people are spending in the airport on handbags and alcohol and parking, etc. And then usually the airports take a percentage of that. And finally, there's property and a rental return on the property. The first two are the majority of the income in most cases, and obviously when passengers have fallen, the profitability of the airports across the board has fallen considerably. So what's actually happened? On the next slide, you can see that traffic fell significantly during the pandemic as economies locked down, as restrictions on movement were put in place. Traffic fell. I think April was at lowest point, and it fell around 95%. International fell 98, 99%. And largely the only flights that were happening were essential travel and repatriation flights. There was a little bit better on domestic, but still very, very low levels. So what's happened since then? So if you're looking at the recovery, domestic is a good place to start, with international borders still largely shut. You can see the US domestic market bottomed out around 96%. By September, it was back to about 65%. Anecdotally, Thanksgiving Day was the busiest day they've had since March. So there is some element of growth back in the domestic market, notwithstanding the fact that there's still a surge in virus activity in the US. Europe's a bit different. Airline traffic bottomed around 98%. We start to see a recovery in August in the summer as the European market opened up again. But as the virus started to resurge in Spain and France, etc., numbers headed south again in September. October will likely be worse than that as economies locked down, particularly in the last week or two of October. We saw lockdowns across Europe, and again, November will be worse again, although they are talking about now easing restrictions for Christmas time. Asia Pacific is an interesting area. Again, traffic declined heavily in April. September was a lot better, but within that, China's a really interesting one. China domestic travel bottomed in February. Obviously, the virus hit China first. It bottomed out about 74%. The decline in September was around 3%. Talking to the airlines and talking to some of the airport companies in China, they saw positive traffic in October. So clearly, we're seeing a wholesale recovery. Now, China's probably a little bit special in that they had the ability to very quickly lock down regions. They have the ability to track and trace very effectively, but they've been quite good at combating the virus, and that's giving people confidence to travel. Also be aware, with international markets shut, some of that travel has been reallocation of international to domestic travel. New Zealand, again, is a good example where they've got the virus under control. Traffic declined around 98%, 99% at the height of the pandemic in April. By September, it was back to 53% for domestic travel. October was in Auckland Airport, was around 35% down. So we are seeing a recovery in traffic as the virus gets under control. So what are the airlines saying? The airports saying? Well, IATA, this is the International Air Traffic Association, expects the recovery to take till about 2023, 2024 to get back to 2019 levels. The airports have been a bit more conservative by and large. So Zurich has been the most aggressive and they're suggesting 2023 is when they get back to 2019 levels based on the strength of their economy and the strength of their airline. Fraport is the most bearish, saying 28 to 31, given they have a high amount of intercontinental travel and a lot of business travel. Within that, though, they all kind of admit they're guessing a little bit. We're in uncharted territory. No one really knows how things will come back or how quick they'll come back, but these are the best guesses of the airport companies themselves and the air traffic body. Looking at the next slide, you can see through history what's happened when we've seen shocks historically. So you look at 9/11 or the global financial crisis, two of the biggest shocks in aviation. Very quickly, you saw a recovery, not just to growth, but back to trend. We think this time it's going to be a little bit different. We're being a bit more conservative in the way we think about the recovery. So obviously this year has been a very, very substantial decline. We're talking to the 65% decline in traffic. But when we recover, we don't expect to recover necessarily to the trend line. We've got a combination of structural shifts, being things like moving business meetings to Zoom, etc., as well as the economic impacts. Will mean we'll probably end up at a lower level than the historic trend. We'll go back to similar growth rates, but start from a lower point. So we're looking at roughly a 10% lower level of traffic in 2024 than our prior estimates, roughly equivalent to 2019. So when we think about the investment performance, when we're looking at the individual airports, we try and break it down into the type of air travel and the type of passenger. So first of all, domestic, we expect to come back first, and we're indeed seeing that already, followed by regional travel. So think of EU as a block, or think Australia, New Zealand travel bubble. And finally, long haul international will be the last thing to come back. And also the reason for travel. So visiting friends and relatives will come back very quickly in our view. If you haven't seen your parents or your children for a year, you're very quickly going to hop on the plane, assuming it's safe to do so, to go and see those people you haven't seen. Leisure travel, again, will come back. I think it's pent-up demand for leisure travel. People haven't been on holiday for a year. Again, that will recover quite quickly in the short term. The big unknown is business travel. We're seeing wide ranges of estimates as to where this will land, but certainly some of those marginal trips will disappear. The flights down to Melbourne from a single meeting from Sydney, for example, may be done via Zoom. So internal training sessions can be done via Zoom or via Teams, etc. We just don't know what that impact will be. Again, the best estimate we have, or one of the most conservative estimates we have, is from Fraport. They have about a third of their traffic as business travellers, so they're very focused on this, and they're assuming about a 25% reduction in business travel over the long term from this structural shift. And that's not to say they're right. Again, they're guessing, but that's their estimate of the impact. So what's the impact been on performance? Well, to the end of September, the return for the year was minus 35%, give or take. Now that has to be framed. This is prior to the vaccine announcements from Pfizer and Moderna. If you roll forward 2 weeks, they're actually down 20% for the year. They've actually performed very, very strongly off the back of the vaccine announcements. That just means a narrowing of the range of outcomes here. Again, Gerald said we thought these things were cheap. The problem is the range of outcomes have been very wide. With the vaccine announcements, that range of outcomes narrows considerably. So moving on to rail. Rail is a very interesting sector for us. It's probably the most economically sensitive of the infrastructure sectors that we invest in. We would ordinarily expect significant declines in volume to occur in line with GDP. And we saw that to a degree at the start of the year. We saw traffic volumes off 20 to 25% in the worst weeks. And you can see it on the chart here, the car loads and the x-axis is the week of the year. Now, what we've seen since then has actually been a bit of a surprise to a degree. That the strength of the recovery in traffic volumes has been, we think part of this is due to restocking. In other words, people didn't order stock they needed or simply couldn't get it. And as the economies open up, there's a restocking cycle that's taking place. They're all tracking ahead of last year's numbers in terms of car loads. So the volume story has actually been quite a good one. Now, when we invest in rail, we don't think of it as a volume story. For us, this has always been a cost out story, an efficiency story. And you can see on the next page, the rail companies have done an extraordinary job of actually stripping out costs. So what you're seeing here is operating ratio, which is effectively the costs relative to gross profit. most of these rail companies have been undertaking efficiency drives known in the industry as PSR, precision railroading, and looking to strip out costs and make operations more efficient, reduce dwell times, reduce headcount, making paths more efficient for trains to travel on, making trains longer, etc. What they've done in the pandemic is not waste a crisis. They've actually been able to accelerate a lot of these things that they were already doing when volumes came off. So the really important part of this chart, not just the trend downwards, but the last 2 quarters, you can see a tick up in the operating ratio in Q2, as you probably expect as volumes fell. But as volumes have come back, the operating ratios are at or near record lows. In other words, they've put these efficiency drives in place, and they've held on to these efficiency gains even as volumes have come back. And that's been, as you can see on the next slide, that's really been reflected in the returns that the sector's achieved. So again, we expect traffic to normalise over the long term. The current spike is something to do with restocking. We would expect probably at a slightly lower level than historically we would have in sort of 2023, 2024, simply because of the economic impacts. But from a return point of view, for the year, these guys returned close to 12% for the 10 months to October. Again, post-vaccine, they're up at around 24% in mid-November. So they've done it exceptionally well. And with that, I'll hand over to Ben.
Great, thanks, Offa. Similar to what you just heard from Gerald and Offa, I'm going to walk you through effectively the toll road sector, and then what we call the telecommunications infrastructure sectors. Really, what I want to do is just focus on how we're seeing these assets performing in the current market environment. But then I want to switch and talk a little bit more about how we think about the outlook for these sectors and what's going to drive their performance, their operating performance in the future. So before I dive onto the chart that you can see on the screen in front of you, when you think about a toll road, and I know this is not news to anyone who's dialed in to the call, but the investment case I think is worth reminding that the reason that we like an investment in a toll road asset is because these companies, by their nature, they are contracted concession businesses. Those concession contracts give you a high degree of confidence as to what you can expect on the pricing side. So there's going to be a pricing path that's envisioned within that. The piece that you need to get confidence with on a toll road is that, and obviously you can see in the chart there's been some short-term issues, but really when we think about investment, it's a long-term structural story that we're looking for, not a shorter-term movement. So with a toll road, the advantage you've got is that whilst prices might be set under the concession contract, ultimately the benefits and risks of volumes fall to the operators. And so where you can get a confidence around the structural growth trajectory in both the economic activity of that region, and B, say the population growth, it's going to deliver a nice and growing return profile for investors. So what have we seen in this calendar year so far? So what you can see on the screen in front of you is effectively a set of indices. These are 3 different toll road networks in Europe. So one based in Italy, one based in Spain, one based in France. Really what it is, by the way, is this is week on week traffic compared to the prior year, just to orient you on that chart. What you can see is it's very clear looking at that chart, the impact, the depth of the lockdown had on these assets. So you can see during the downturn, you had a very significant fall where these assets were sort of bottoming out around about 80% below their prior year's level. Within that, what is interesting is you saw a divergence in the performance of underlying traffic types. So on one hand, you had car traffic, which does make up the lion's share of patronage on these roads. But car traffic was down probably 90%, if I think of a few examples in there, during that bottom. Whereas truck traffic was down probably about 50% during that period. So what you did see is there was a base load level of underlying economic activity that carried on. And what that meant from a toll road operator point of view is there's actually and I don't want to pretend this was a huge benefit, but certainly you did see a positive benefit for toll roads at that bottom, because you have trucks that typically pay a higher price than cars. So you did have average yields up significantly during that period on motorways. And then what you can see, and this is really, I think, for me, the key takeaway of this chart is you can see the recovery trajectory that comes through. So you can see as you then sort of, you come out of the depths and lockdowns start to be removed, and at least wave one in Europe starts to get under control. You can see the effect on traffic. The rebound was strong, and it's for us, it's quite pleasing that pent up demand and that resilience of underlying traffic is strong. And so what you can see is as you move into the European summer, you had roads who were getting up to basically line ball with the prior year, and some actually even exceeding. So what was driving that? It was factors like trade down holidays. Officers talked about the airports and where they're at. So a lot of people weren't flying. So they were taking driving holidays over the European summer. The other thing as well that we've received feedback on is just the number of people who are driving for safety reasons. Public transport, people prefer to be effectively driving for safety. So, for us, that's a key takeaway. And then you can see it on the far right of that chart. Obviously Europe's dealing with their second wave at the moment, and you've had increasing numbers of restrictions put on mobility again. And you've seen that decline in traffic commence. So this is going to be an issue that until a vaccine is broadly available, which can mitigate the impact of the coronavirus, there is a risk that you get those temporary downturns. But the thing that we take away is that we've been pleased with the recovery profile in toll roads, particularly as we sort of compare to some of the other transport infrastructure slides. If we go to the next slide, we can see the same thing, but now I'm talking about urban motorway traffic. And so the thing that's interesting about urban motorways, I'll probably describe that in general, urban motorway traffic within cities, as opposed to a lot of the European stuff we were talking about before, the interurban roads. A lot of the urban trips, it's going to be a lot more essential in nature. It's people getting on with their daily lives, as opposed to the longer haul it is, typically it's going to be less essential to your day-to-day. And so what we've got on these charts, some people on this call may have seen this data available before, but effectively this is the mobility reports that both Apple and Google put out. We've chosen the Apple one here, but what it shows you is how much people are requesting directions on the mapping services, and it compares to the baseline back in January. So it's not a perfect index, but it does give you a pretty granular and simple proxy for what's going on in different cities. What you can see in all cases, you can again really see that impact of the first wave hit in the urban traffic. What you can see is that compared to the interurban roads, where you had about down 80% on average, the impact was less severe on the urban motorways. We would generally expect urban motorways to be more resilient than interurban motorways. We think the risk profile is subtly different, even within toll roads. So what you can see here is then as you look at Brisbane and Sydney, you can see that recovery, similar to what we just looked at in Europe. That recovery story is healthy. So you can see you're getting back up to decent levels as the first wave fears start to recede. In the case of Sydney, you can see as the virus began to pick up again in Melbourne, you could see there was some downturn in mobility. And then obviously when you look at the Melbourne traffic, you can see the tougher time that the city and the state has had with managing the virus in this year. And you can really see that effect where you sort of went down to that second impact. But once again, the thing I'll just call out is you can see that recovery profile coming through pretty quickly as the virus concerns sort of start to move into the background. On the next slide, we have, this is actually, so before I was just giving you the Apple mobility data, this is really just going back to now some harder data. So it's telling you a very similar story to what you just saw, but this is some of the transurban numbers that they've put out. And it shows you 3 assets that we've selected to give you a sense of how they've performed. And so again, you can see that traffic down that circa sort of 50% for the month of April. And you can see that that's basically started to recover as you get towards in places like Brisbane and Sydney, as concerns about that virus have started to recede a bit. In Melbourne, obviously, the recovery is still coming through. So if we go to the next slide, what is the outlook that we have for motorway assets? The way we think about this, and Offer before started to talk about this, when we think about that recovery, it's almost as if we think about this as it's going to be waves, almost like ripples in a pond kind of thing. You're going to see the assets that will recover fastest in this space are going to be those that are exposed to the shortest haul trips. So we think urban motorways will recover fastest, followed by, say, interurban roads. And then as I sort of even just cast that analogy out just to piece the sectors together, then you might start to see, domestic flights, international flights, to sort of get that ripple out as the concerns abate around the virus. When we think about the traffic trajectory, obviously we've got to get past this phase where economies are really grappling with the virus. But then really after that, it becomes, where do we think it gets to over the medium term? Where do we get back to relative to 2019 levels? At this stage, we take a conservative view. We do assume that it takes a few years to get back to that level without putting a precise number on it. But we do assume it takes slightly longer to get back there. But we think the thing that we've really taken away from the data that we've seen in this year today is just that resilience and the rebound that we've seen in the space. So in terms of the market performance, it's quite interesting, because when you look at the data to the end of October, you can see that the average toll road that we consider investment grade was down 18%, effectively just reflecting the market's concern about what everything we've talked about on the traffic side. But what is pretty interesting is obviously November has been a strong month in markets more broadly, particularly as those vaccine announcements have come out. What you find on the toll road space is that -18 moves, if you go to the mid-November, that number goes to about -4. So a very quick and sudden reversal in the performance for the year to date. So with that's toll roads. If we jump forward, telecommunications infrastructure. This is quite an interesting one, because we've just spent a bit of time talking about effectively those sectors that we think have had more exposure. But some sectors have obviously had more resilience, like utilities, and other sectors have been unaffected, if not positively supported by the trends that we've seen this year. So telecommunications infrastructure, as a reminder, for us, this is really investment in mobile phone towers, so the vertical real estate on which the mobile phone carriers can hang their equipment on. And so what's driving these businesses? And we sort of think about what's happening this year. It certainly hasn't been impacted by the coronavirus, and I'll come back to that with some data. But what is really driving these businesses is what's happening more broadly in consumer consumption patterns for wireless data. So there has been a huge and explosive growth in wireless data demand at the consumer level. And the thing that's interesting, when you then think about the infrastructure piece that's got to be solved with that, effectively what you have is mobile phone operators will need to deal with this burgeoning demand, and they've got to infill their networks to try to deal with this. And we go to the next slide. I'll put some data around just how significant this growth is in the data demand. So what you can see, it's slightly busy chart, so I'll quickly orient you on the chart. But what you can see on the far right is effectively the answer. And what that shows you is the total expected growth, 2019 through to 2025, of US mobile data demand. And you can see it's growing at a compound annual growth rate of 32%. So just massive, massive growth. Now, what is driving that? Really, it's a couple of things. So then as we sort of start to walk back in terms of the drivers, you can see on the far left is the total number of mobile connected devices that are expected. So you can see very, very, very solid growth in that. And you can see that's grown by about 8%. So it's an important driver, but not the only driver. And then in the middle is the expected demand per connection. And that is a massive, massive driver. And it's exactly the things that everyone would be very familiar with. It's that ongoing use of data demand. Now, as before, I sort of talked about, I mentioned that you think about sectors that are, if anything, have the current environment has provided a structural tailwind. The increasing prevalence and use of things like video services and realizing how much it's critical to be connected and the ability to work from home, it's certainly supported this thematic. So if anything, there's going to be more investment in our conversations with management teams in this space off the back of what we've seen this year. So we go to the next slide. This is really then about how do the infrastructure companies help to deal with this problem. So what you've really got is, as you think about that growing demand, there's a couple of levers that mobile phone companies can pull. One of which is trying to provide more spectrum. That is more difficult. It's a more competitive game, trying to provide spectrum to increase total capacity of a wireless network. The lever that they can pull, and they are pulling, is really around increasing the number of receiving points. So it's increasing the access points to the network so that you have less average users per access point to try to deal with that increased load. And so traditionally, if I can sort of frame it that way, the driver has been around macro towers. So it's been, you can see in the center of that diagram, it's the mast type macro towers or the rooftop macro towers. But what we're seeing more and more is, as you get this huge growing demand, is that network operators are having to find more ways of dealing with this. So that's where things like the outdoor DAS and indoor DAS, where you install networks within stadiums and shopping centers, hospitals, areas like that, and you'll have networks to try to deal with the high population densities that you'll find in those areas. And another area that you're seeing some deployment and work towards is in small cells. And these are really, again, they're about small receivers that are placed to try to help backfill the capacity on macro towers that are getting too overloaded effectively in certain areas. So the nice thing, if you think about some of the operators in this space, the benefit they ultimately get is that as these network operators keep trying to densify, as they call it, densify their networks, effectively, if you have a portfolio of towers and a portfolio of these assets, as different operators come to you and they need to hang more equipment on your assets. So you're increasing your rental yield and you get to actually spend and grow your infrastructure base as well. So it's a strong growth opportunity. It's a very strong structural growth opportunity. On the next slide, how do we see the outlook? The coronavirus and what we've seen this year in particular, it has not been a major issue for these companies to deal with. The easiest way to probably explain this is just to give a couple of examples of how these companies are performing this year. So in the case of the US tower companies, which is an area we've probably focused on more in the past, if you take for one example, which is Crown Castle, they are saying this year they expect their cash flow growth should grow by 11% this year. And likewise, AMT at 7%. So there's going to be, and those numbers in context don't mean much, but I think the key takeaway is that the companies are doing healthily this year. They continue to grow strongly. And what you can see on the slide in front of you is very much the markets have recognized this, and the performance of these companies to the end of October has been very strong. So if we go to the next slide. With that, I might move to wrap up the presentation, part of the presentation. So what we sort of talked about, and just to recap what we've talked about in this this brief update, we've talked through the different subsectors and how we've seen A, the impact on those businesses, and B, what we think the outlook is for those companies. Now, you can see where the portfolio is positioned as at 30 September. You can see that we have a significant weighting to utility companies. The investment case, we think is quite attractive there. These are businesses that through effectively this year have again been able to prove just how resilient and how much sort of lead in the keel they represent to an infrastructure portfolio. But not only that, these assets in a increasingly low rate environment, they continue to earn very attractive rates of return on their capital with a risk profile that we think is quite attractive. So Gerald mentioned this earlier, but this is effectively a space that we think actually looks quite interesting at the moment compared to history. On the infrastructure sleeve of the portfolio, it's different drivers. So we have talked a bit about those sectors that are probably front of mind for a number of people in the audience, particularly around toll roads and airports, those that have been more impacted. You'll see that we have, in particular, probably biased ourselves a bit more to toll roads. The reason for that is to do with our confidence. We think the range of uncertainty on toll roads is less than airports, and we're reflected the positions. But we can see interesting valuation opportunities on both sides. I won't go through every one, but for example, rail is an interesting one where, again, you might think that's a volume investment story, but really it's about a cost out story. It's a structural cost out story that's driven the earnings profile of those rail companies. So overall, when we sort of go through the portfolio and we sit back and the exposures, we think the portfolio looks well positioned as it stands today, and continues to provide a good backdrop in which to deliver against that CPI +5 type return that we'd expect out of infrastructure. Now, with that, I'll hand back to Al, and I think we'll do some Q&A at this point.
Thanks very much for that, gentlemen. That was an excellent overview. I think it'd be fair to say from what you just articulated, Ben, that we do see some value in airports and toll roads in particular, but it's not without its risks. So you need to be really careful about how you're allocating to those two sectors at the moment, given that we still have quite a lot of uncertainty around, the health outcomes, with COVID. The other question that's coming up is, we've got sort of circa 10% cash in the portfolio. What would you be looking as a trigger or inflection point to actually start deploying that cash? And intuitively, what sort of sectors would you be thinking about deploying that cash into? Gerald, maybe you're best to.
Yeah, look, at any given point in time, what we're looking for is the best available opportunities, and we don't come at this with a pre-designed view about which sectors we're going to invest in. So if we think about what the sectors are that we can invest in at the moment and what the outlook for those sectors are, as we've tried to say today, utilities have shown themselves to have incredibly resilient, reliable, predictable earnings, even in the face of a global pandemic. We think that they represent attractive value, and we're certainly looking long and hard in that space. And over the course of the year, that's where we've been allocated. To the extent that we've been allocating capital out of cash, the bulk of that has gone towards utilities. So we're certainly looking in that space. As Offa pointed out, IATA, the Global Airline Alliance, have suggested that their base case is that passengers in the aviation sector globally will get back to 2019 numbers in 23, 24. The airports are more sanguine about that. They go from sort of somewhere between 2024 and 2028, depending on which airport company you talk to. And what that tells us is, generally, we're all pretty confident that passengers will come back to aviation, but there's a wide degree of uncertainty. So the extent that we're going to invest further capital into that sector, we're looking for more confidence in the potential outcomes there. That goes to confidence about not just finding a solution in terms of a vaccine, but a logistics solution. How will that be rolled out, the pace at which that will be rolled out, and what does that mean? So we certainly would expect that in the future you'll see a higher level of weight to our airports than we currently have, but it's going to take some time to get there, would be our expectation. Toll road values were down significantly to the end of October. They've rebounded pretty substantially through November. We've seen that traffic levels are fundamentally resilient, and that's probably not surprising to us. Ultimately, traffic is a function of the total population and the total level of economic development in a catchment area. And while the pandemic may lead to negative economic growth and a slowing or even a slight reduction in the population, the total stock of population and the total stock of economic development is unlikely to change. So ultimately, those key drivers of traffic we don't see going away, and hence traffic is resilient in the face of that. So we're certainly looking in that space. We have had allocated and have over the year additional capital into that space. and we continue to look for that. As Ben has suggested, both communications and rail have done pretty well through the year, as Offa showed you on rail and Ben on communications. We think there's a strong fundamental story, but it's, in our view, it's harder to find attractive or companies priced at attractive valuations there at the moment. So they're probably not the sectors that we're particularly focused on at the moment. So for us at the moment, it's more about toll roads and utilities, but we're looking across the space, and from time to time, valuation anomalies present. We're certainly looking long and hard, and there are opportunities across the space at the moment.
Yeah, a pre-submitted question, perhaps for you, Offa. How do you foresee the future pros and cons of investing in listed infrastructure versus unlisted infrastructure?
Sure. Thanks, Al. It's always an interesting debate. People constantly ask this question, particularly investors, given the opportunity set. One of the key things to remember is the opportunity set is very limited, particularly in both of them, but the access to those deals is very limited in the unlisted side. There's currently about $230 billion of unspent equity capital in unlisted funds globally, infrastructure funds globally. What that means is you're competing very heavily for those deals that are available, and it also means you're probably going to end up with a very skewed portfolio. What we see at the moment is on the unlisted side is a lot of renewables. Now, some of those are fine. They're probably at the margin of what would be considered infrastructure given the contract structure. So 15 years would be okay if you're exposed to recontracting risk, for example. What you get access to in the listed market, is first of all, the pricing tends to be a lot better. So we've seen time and time again, transactions happen in the unlisted market, given scarcity value at much higher premiums. You get liquidity, so you can access a broader range of assets at better prices as well, so you get a much more diversified portfolio. So you'll end up with a much more robust portfolio in the listed space than you will in the unlisted. What you're giving up though is control. Usually in the unlisted space you get control, but you certainly pay for that. So we spend a lot of time trying to understand motivations of the management team in particular, and you'll be aware that we have quality scores, and it's very heavily weighted towards agency risk, trying to understand what the management intends to do with the cash that these companies generate, and that's sort of 30% of our weighting to that risk score. So while we don't have control, we're trying to account for it in other ways.
Yeah. A question for you, Ben, and we've sort of partly touched on this during the presentation. Do you see longer term structural declines in the use of toll roads because more people are going to opt for to work from home rather than travel into the city and work from an office?
Yeah, it's a question. It's an interesting question. Now, obviously, it's one of those uncertainties that you face in a lot of sectors right now, as people think about what are the changed consumer behaviours effectively off the back of this virus, and the fact that we've all become pretty used to where people are able to, we've all become pretty used to working from home. We've all become pretty used to doing Skype calls and things like that, or Zoom calls. And the question mark then is just how much of those behaviours become sticky. That is an uncertainty. It's an uncertainty that until we get there, we're not going to know how to resolve it. The thing, and as always, investment is a game of trying to frame these kinds of problems. And when we think about particularly the exposure that you would face, the things that we probably keep in mind, one, so when you think about commuter traffic, we're talking specifically about commuter traffic. So the question then becomes, one, how many people are using motorways are driving to and from work? And then secondly, how many people of that, how many of that proportion can actually then work from home? On that, we don't have a lot of data, but we do have some data points on that. We've spoken to an urban motorway operator who suggested that they think commuter traffic is probably less than 20% of their overall network. And then there's been some reports, a consultant report out recently, and this is particularly focused on the European market, but we'll sort of take that as a proxy for the time being. And it sort of suggested that the number of people that they estimate based on professions and capacity to work from home probably ranges, and this is only 3 days a week, by the way, they were framing this as, probably ranges between 18 and 27% of the workforce, right? So if we say, let's just round it and say it's something like a quarter of the workforce can do that, and less than 20% of the total traffic pool is commuter traffic, you multiply them out, you're looking at about 5% of at-risk traffic. So, we think we've kind of captured that. And as you sort of pointed out, we sort of talked about how we've taken a more conservative stance. And we think we've kind of captured that risk in the way we think about value and, the handicapping of the space. But we don't think it's going to be it matters, but we don't think it's as large as you might think anecdotally.
Yeah, it's interesting, isn't it? Because if you sort of look to the US maybe as a reference point, some of the major corporations have actually almost demanded that their staff come back into the office because they're seeing productivity declining, and then other businesses have actually suggested that a portion of their staff will be permanently working from home. So it's going to be really interesting to see how it plays out in the long term. Maybe a question for you, Gerald, and this is obviously something that's front of mind in just about every discussion that we have now, is how is the portfolio positioned for climate change?
As you say, Al, it's a constant topic of discussion. The major sector that faces impacts from climate change is utilities, the provision of energy. If you think about utilities, if I go back to definition, we seek to avoid things with competition. If you think about the utility industry, there are four major segments to the utility industry. That is generation, transmission, distribution, and retail. So you generate power, generate electricity, you send it down high voltage transmission lines, you step the voltage down into distribution lines, which come into your home or place of business, and then someone sells you the electricity. That first bit, generation, we avoid if it's competitive. And we avoid it because it's competitive, and we avoid retail for the same reason. So really, what we're investing is the poles and wires, the transmission and distribution assets. As a consequence of that, because we're not in generation, we're not too concerned about the impact of carbon in the short term. In other words, we're not an investor in renewable energy, not a direct investor in renewable energy. We're not a direct investor in fossil fuel-based energy, so we don't face that conundrum. Indeed, for our companies, if you go back and think about the economic model that we talked about earlier in the presentation, these companies earn a return on their capital that they've invested in the business, provided they invest that efficiently. So it's in their interest to invest in as much as they possibly can. And therefore, because of that, the thing that they have to focus on is, are there investable opportunities, A, and then B, at the bottom of that economic curve, as I said, is the setting of price. And that is, the more money you invest in your capital base, then ultimately that flows through to a higher price, unless you're able to reduce your costs along the way. So you, as a regulated utility, you want to invest as much as you can in your capital base, but you've also got to be cognizant that you don't want to put up your prices too much. Otherwise, consumers will scream. You'll face some political pressure, and we've certainly seen plenty of that around the world when electricity prices are going up. So as a consequence, what renewable energy has been able to do for these companies, to the extent that renewable energy is replacing fossil fuels, at the moment it's really replacing fossil fuel-based coal and nuclear and other fossil fuel-based energy forms. It's replacing it because it's cheaper. In most jurisdictions today, solar and wind is cheaper than fossil fuel-based energy. And as a result, that leads to a reduction in the cost to consumers. So as a consequence of renewable energy, the poles and wires, the transmission and distribution companies face this situation where they can invest in their capital base because they're reducing their costs along the way. The cost of the energy is normally a pass-through, so they pay the generators for the energy, they charge for that energy at the same price that they pay for it to end consumers. So if they're reducing that part of the bill, they can actually increase their investment in their capital base, such that their profits increase, but the end customer bill does not get affected. And they can do that by, first of all, connecting to renewable energy, so they can invest in their capital base to connect to those things. They can also invest in the sorts of measures we would hope they'll invest in, making the network more efficient and more effective, very good for carbon emissions generally, and more resilient. in the face of bushfires and storms and the like. So climate change generally is a significant opportunity for the utilities.
Yeah. Maybe just an in closing question. Given some of the promising results that we've had in relation to the Pfizer vaccine and so forth, and also the challenges that infrastructure as an asset class has faced this year because of the pandemic, is the worst ever for the sector.
So again, if I would go, so the answer to the question is yes, assuming that, not knowing what the future holds. In other words, the future is uncertain, so we don't know what other challenges the world will throw at us over time. But if we assume that we're on a path now towards efficient production of vaccines and that will roll out over the medium term, and not knowing what else the world will throw at us, then we would expect that the investment outcomes will gradually improve. There'll be some volatility around that, but things will gradually improve. Of course, we need to think about that in the context of the different sectors. Utilities have shown themselves to be very resilient through this time. Airports have suffered a significant reduction in patronage over the period. They're progressively recovering, as Offa showed you in the charts earlier on. There was roughly a 95% hit to passenger numbers globally in airports in the month of April, and we've seen green shoots really subsequently. We've seen a gradual improvement in the passenger numbers, and we'd be confident that over the next 3 to 5 years, we'll see passenger numbers return to something approaching normal, if not above that. Similarly, in traffic, in toll roads, we've seen an initial significant shock to traffic levels around the world, but and a much more rapid recovery in those jurisdictions in particular which haven't had a second wave. Where there's been a second wave, the traffic has worsened back again. But we can be confident that those numbers will improve. So as we move forward, we would continue to expect that things will progressively get better. But as I say, the future is uncertain. We don't know what else the world will throw at us. We certainly weren't expecting at December last year that this would be the year that we would have. And therefore, on the basis of what we see plenty of opportunity. We're seeking to allocate capital in a responsible, disciplined manner to those things that represent the best value with low degree of inherent risk, and we're proceeding down that path.
And given your elevated cash position, still you've got plenty of dry powder to deploy if and when the time.
Yeah, absolutely. I said earlier on in the presentation that what tactically what we've been doing is from March onwards, really, when we went to 15% cash, was to progressively allocate that cash back into the portfolio, looking for those things with very limited downside but some degree of upside. We continue to do that, and we'd expect over the next 12 months or so to get back to a normal cash level.
Yeah. Well, thank you very much, gentlemen. In the interest of time, we might just end the formal part of the presentation there. There are still a number of questions that have come through. What we will do is endeavour to get back to you. One of the key account managers will get back to you and hopefully be able to answer those questions. You'll shortly be receiving an email from us, which will have a feedback link. So if you want your CBD points for this presentation, please fill in the feedback. And there'll also be a link to the recording, which will be housed on our webpage. God willing, this virus will stay away for the foreseeable future, and we all have a COVID normal Christmas. So to everybody, and your families, have a safe and very, very happy festive season, and I look forward to a more positive year in 2021. Thank you very much for participating in today's webinar.